This is my third seminar, and what's very notable looking at the first slide of my presentation is that the volumes are still growing. So 2017, 2018, we have grown since what was a very good performance in 2016, and year to date we're at 9 billion euros of investment in the CEE region. We published this morning a Q3 infographic detailing that figure and others looking at the CEE 6 countries, and that 9 billion volume is 14% ahead of the volumes that we saw in 2017 year to date. So we're in a good situation in the cycle. The question is, how long does this go on for? If we're looking at what countries have seen that flow this year, it's really Poland. Poland's driving the region, 5 billion of volume so far this year. We think that this may exceed 6 billion altogether in 2018. Czech Republic's seen a weaker flow, down over 50% year on year. Lack of product is a bit of a problem. Hungary and the other markets in Central Europe have seen similar flows that they saw in 2017. On the sector front, we've finally seen the office sector in 2018 overtake the retail sector. Retail has seen very strong volumes in Central and Eastern Europe since 2016, 2017. Finally, office is performing better than retail. We've got 3.9, nearly 4 billion of volumes in office versus 3.5 billion in the retail sector, and that's a reflection of the maturing of the cycle in the region. The amount of development activity that we've seen in Central and Eastern Europe over the last year or so is pretty impressive, and that is then driving additional office volume into the investment market. So quite healthy growth, but again a sign that the cycle maybe is maturing. If we look at where the money comes from, we've seen since 2016 what we termed in a piece of research in early 2017 a changing of the guard. We've seen Asian investors, the red on that pie chart on the left-hand side, Asian investors coming into the region. South African, the gold on that graph, South African investors since 2016 very active in the Central and Eastern European region, and the biggest single country of investment in 2017 was South Africa, but in 2018 over 15% of the volumes coming from there. But it's also the domestic investors, the domestic sphere, the Central European investors. So the light grey bar of that left-hand side pie is domestic to domestic. So Czech investors investing in the Czech Republic, Hungarians investing in Hungary, Romanians investing in Romania, etc., make up nearly a quarter of volumes in 2018 so far. On top of that, we have cross-border investment in Central and Eastern Europe. So Czech investors investing outside, Slovak investors also investing outside of their country. Money deployed elsewhere. So in these countries in particular, the capital's been exported. If you add those two figures together, that's over 30%, 3 in 10 euros that have been invested in the region this year are coming from within Central and Eastern Europe. Now, the domestic flow is important in terms of market stabilization over a cycle. It means that when a downturn comes, the investors are there, they are prepared to invest in assets which foreigners may not look at. They're prepared to invest at high yields as more secondary assets. So they are there, they're very much playing in the market and are able to stabilize. They lend stability to an asset market. This is the case in East Asia, this is the case in other emerging markets, this is the case in the biggest markets in the world, in the US and in Europe. Domestic investment is very important, and in Central and Eastern Europe this is continuing to grow, and it's a great positive for the region over the next cycle or so that these investors are present. On the right hand side, what we've got there is the vendors, the sellers. So the net sellers in the region over the last year, and certainly over the last 3 or 4 years, have been Western European investors, UK investors and US investors. So the blue, the segment of the pie is in blue, are those from the traditional sources. Now you can see on the right hand side that section of the pie, over 2/3 of the pie, is bigger than it is on the left hand side. So they are big net sellers. They are selling more than they are buying. So that's an interesting signal for us in thinking about where we are in the real estate cycle in Central and Eastern Europe. Now, why might they be selling, or what's happening in the economies? What's driving the volumes? Actually, it's linked to economics. It's linked to GDP growth. If we look at GDP growth across the region, 2016, 2017, 2018 on this chart, you can see a bit of a hump in growth in Czech Republic and Romania, in particular in 2017, and in 2018 the growth has slowed. So certainly in those two economies, the economies are slowing down from those peaks. In Poland, in Slovakia, in Hungary, the economies are a lot more resilient. At this point, the GDP growth performance is strong. Poland there, 4.6% GDP growth, maybe up to 5%. Let's see for 2018. It's a lot more resilient growth, and therefore, if we look at the investment volumes, the change, year-on-year change in investment in Poland, we're flying high, 110% up. In Slovakia, it's steady. But in somewhere like Czech Republic, where that growth, economic growth has turned over, we've got 52% reduction in flows, a relative lack of product. Foreign buyers are not finding at these yields in the Czech Republic attractive investments. So bit of an issue there in the Czech market. Now, why is the Czech economy slowing? What's going on? What's driving that GDP growth weaker? Looking here, the German locomotive drives Central and Eastern Europe. Exports to GDP in Central and Eastern Europe are very high compared to other countries. We're talking 80% in the Czech Republic, over 80% in Hungary and Slovakia. So, got here on this chart the German IFO index, which is a leading indicator for the German economy. This is the IFO Institute in Munich. They monitor 5,000 to 6,000 companies, Mittelstand, various size companies, very well respected institute, a leading indicator published every month. The capital markets follow this indicator. They follow it very closely and react to it. And this indicator has fallen over the last few months and is quite at a reasonably weak level compared to recent history. You can see on this chart, if you push back in time, the Czech Republic's industrial production, and I've got a year-on-year growth rate moving average on this, and on the grey line on this chart. The Czech line is almost matching quite well the German IFO. So the German economy pulls the Czech industrial production along, and therefore we should expect over the next few months some weakness, some relative weakness in Czech industrial production growth. So thinking about then Czech exports and therefore GDP growth, we should expect therefore some slowing, further slowing, or less, or certainly not a rebound to a peak in the Czech Republic. This will be a big surprise. Then obviously what I'm going to be doing over the next few months, as I always do, is look where this IFO is going, this blue line. Does it go up? Does it go down? And that will tell us something about where the world's going and where Central and Eastern Europe is going. What we do know is that on the export side, Germany exports a lot of its own GDP, and the euro has weakened over the last few months. It's fallen from around 123 to the dollar to below 115, now 113 as we speak today. And if that continues, then the German economy gets some competitiveness, gets a boost to its activity, and therefore we may see that IFO index rise again. So we'll see. This is what we're judging. This is what we're following at this point to see where this blue line is going. But the moment it's showing that will be some softness in GDP growth numbers. A bit more optimistically, and also feeding into the real estate sectors more directly in Central and Eastern Europe is consumption and wage growth. Now, what we have is several things going on that are very significant. First of all, that we have very low unemployment in the region. And we're talking about the Czech Republic having the lowest unemployment in Europe, 2.3% according to Eurostat. The highest in the region, Slovakia, is still below the EU average at around 6%. But everyone else is between those two figures. So very, very low unemployment across the region. What this means is wage growth. So the light blue bars on this chart show our estimates of wage growth across these economies this year, 2018. And those numbers are pretty strong. 5% Slovakia, ranging up to 11% in Romania, and 10% in Hungary. These figures in those countries were higher, Romania and Hungary, in 2017. So pretty strong wage growth, pretty sustainable, well in excess of CPI inflation. Now, why does this matter? Why is this important? It means that consumers are receiving more money from their jobs, from their employment, and in terms of wages, and in terms of the growth of that amount of money that they are receiving relative to what they're having to spend in the shops on higher prices. So they're having to walk into a shop and pay 2.8% more in Slovakia than they were a year ago on average for everything. but they're receiving a 5% wage rise. So in real terms, they feel richer. And this is across the board, and you see the gaps are quite wide in some of the countries. With that low unemployment that I've mentioned, this is likely to sustain into 2019. So this real wage growth, this gap to CPI inflation looks quite significant. And therefore, we do think that this consumption boom, which has happened on the back of this, will continue. And if that occurs, then this is good for retail. This is good for the logistics sector, because the logistics sector is supplying retail, and therefore the consumption side of the economy looks quite healthy. Now this, again, thinking about the end of the cycle, is a signal in stock markets, certainly is a signal that the end of the cycle is coming, and therefore we think that it's a good thing for now, but it's something that we're watching. Now, how do you solve the fact that you've got these wage rises? Do they matter? We've got a situation where, at present, the wage levels are very low in Central and Eastern Europe. So these economies are very competitive. Even in Poland or Czech Republic, we're talking about 10 or 11 or 12 euros per hour in terms of wages, compared to Germany at 34 euros an hour. So there's still a huge gap. So there's still the ability for wages to increase quite fast and not really affect the competitiveness in the long run. Obviously, company by company, this might be different, but at this point, there's a lot of room. But we still got to solve the labour force riddle. A riddle where we have a significant issue with finding labour. Massive labour shortages, as I mentioned, unemployment is at very, very low levels. So how do you solve that labour force riddle? In Poland, as we wrote in research that we published in July, with this title, Labour Force Riddle, in Poland, they have already, at the end of 2017, around 2 million Ukrainians in the country already. And then the estimates from the media suggesting that this could be 2.8 million by the end of 2018. So quite significant portion of the Polish population is Ukrainian. And 2.8 million equates to around 6 or 7% of the entire Polish population. I mean, this 7%. This is a quite incredible figure to think about. So it's there and it's significant. That is how Poland is solving its labour force riddle. There's other ways of solving it, bringing back workers from the West, the labour force boomerang that we have written about in research before, bringing back the workers who migrated to Western Europe. That's a possibility. Or we have a recession, or technology intervenes to reduce the demand for labour. There's other solutions to the riddle. As I mentioned, I wrote about this in research. But this is a major issue across the economies in Central and Eastern Europe. A major issue for retail and also logistics is the development of e-commerce. So this is the big question really in retail over the next 5 to 10 years, is how fast is e-commerce going to grow? So in Central and Eastern Europe, I published a piece of research in Central and East, looking at this in Central and Eastern Europe. And what we've got is, at this stage, 5 to 6%, it looks like, in terms of, on a relatively conservative modelling by Statista, of retail sales that is e-commerce at this point. 5 or 6% in Poland, in Hungary, in Czech, Romania, it's around about that level. Some of those figures in Poland and Czech in particular might be a little bit conservative, but it's going to take a lot. That would have to grow very quickly to really eat up all of the retail sales growth that we expect over the next 5 years or so. So in terms of the modelling I did, it would take the e-commerce percentage to go up to above 15%, maybe even 20% of total retail sales to mean that overall retail sales from the traditional omni-channel sources don't grow. So if you had zero growth in those omni-channel sources, you would need e-commerce to be about 20% of overall retail sales by 2022. I don't see that as happening. So my conclusion is that in terms of the survival of the fittest, will retail be killed by e-commerce? The answer is probably no, that they probably won't be killed, certainly not before 2022. That's what we set out in our research. Either way, logistics wins. Logistics supplies presently omni-channel, and also as omni-channel keeps growing, as retail sales generally keep growing, that's positive for the logistics sector in Central and Eastern Europe. And they obviously also win if e-commerce grows, because e-commerce needs logistics. It needs to be located. The products do need to be located near to the customers. So logistics wins either way. So that sector is much more of a sure bet, a two-way bet on this situation. Moving on to the office sector, there's two major themes that are affecting offices. There's technology, which I won't really talk about here, but in terms of the development cycle, we've got a signal here that we are towards the top end of the cycle, that we are gradually maturing, that the statistics are telling us that if we look at the square meters under active construction in the capital cities in the countries, they are rising as a percent of total stock. So the amount of new build that's going on is rising in this latter part of this cycle. So there's a great signal here of, well, actually things are heating up. As the cycle heats up, as we saw in the previous cycle in Central and Eastern Europe, but also elsewhere in the world, as the developers get more and more excited, then that's telling us that the cycle is maturing. So it's there. We can see that in the statistics. Budapest illustrates that very well, going down and dipping almost to zero active construction as a percent of stock in 2012, 13, 14, and then rising from the dead and coming up into the mid-teens again. So very classic pattern there. Prague, all pretty much the same. Some classic patterns also of the same thing in Sofia, Bucharest and Bratislava on the right-hand side chart there. So quite significant cyclical movements going on. And as I say, illustrating maybe that we're moving towards the top end of the cycle. Now, risks. A major risk at the moment is rising interest rates. I've illustrated it here with the US 10-year Treasury bond yield. Now, this is the global benchmark yield. It's the risk-free rate of investing across all emerging markets, across asset classes. Obviously, in Eastern Europe, we have euro funding rates, so what the ECB is doing affects this. But all the same, globally, the risk-free rate is rising. The US Treasury yield was below 2% for a long time, and it is now above 3%. Now, this is the rate at which the market is lending to President Trump with his fiscal expansion. He wants to borrow more money. He has to pay now over 3% per annum for 10 years. So this risk-free rate is rising. Now, the effect of this is that asset classes around the world, companies, corporates, are having to then therefore pay more interest on their debt. And the debt piles have grown massively. We're talking 247 trillion of debt globally now, which is something like up 60% over the last 10 years. So quite significant movement upwards in debt levels when interest rates have been very low. And now interest rates are starting to rise. Well, it doesn't take a genius to work out that there's actually a problem there, that over the cycle there will be some payment problems. And this is now being fed into countries like Turkey. So on the right-hand side of this chart is the right-hand side scale is the interest rate for 2-year borrowing in Turkey. In the bond market, government bonds, 25%. Inflation is very, very high now in Turkey. There's some specific factors, obviously, in Turkey that have caused this. But Turkey is a bellwether. It has a lot of debt. And I've been following that market for over 20 years. That's happened this year. That's quite significant. It's telling us something. It's ringing bells that there's a problem in the emerging markets. So therefore, other emerging markets get affected by this. In Central Europe, we're a little bit insulated, but less liquid markets and other emerging markets, places like India, get under strain. India's funding yields have gone up from 7.5% to nearly 9%, or over 9% for 10 years. So this contagion is spreading. And the effect on the real estate sector is that you squeeze the profit. So on this chart here, we've got that US 10-year Treasury yield, the dark blue line there, rising. And the real estate yields in Central and Eastern Europe have been falling over the cycle, as many of you who've been investing will know. The yields have compressed in terms of prime yields, and gradually that gap has closed. And that gap is the profitability. You've got your funding, and then you've got your yield, your return, and it's squeezed. So bit of a question mark. Does this mean that yields have to rise to widen that profitability gap again? This is the question, and this is where we are now at this point. Moving on, where are the yields currently? Well, actually, we've had very little compression outside of the very, very prime assets over the last 9 months. If you look at this chart, I've got the yield levels, but the annotations above the Polish office, retail, and the Czech office yields show compression. 40 basis points Polish office, 100 basis points Polish retail to 4%. The benchmark transactions just happened, and 10 basis points clips off Prague. But the rest have not seen compression since the end of 2017. So these are the 9-month changes I've just mentioned. The rest have not seen compression since the end of 2017. Now, we do see some downward pressure probably in Budapest and Bratislava, maybe Bucharest, perhaps in Sofia, but we haven't seen it so far this year. So are we running out of room in terms of yield compression? That's the question at this point. Well, we might be in this cycle, but if we go on to the next cycle, if we say, okay, there's going to be a peak and then a downturn, will we see lower yields in the next cycle? This chart suggests we will, because on the x-axis of this chart, we've got GDP per capita in European countries across Europe. So somewhere like Germany, 40,000 euros per capita GDP, and the yields, the average capital city prime real estate yield, that's Berlin, is below 4%. So that's plotted on that chart. The Central and Eastern European countries are plotted on the left, and you see if the GDP per capita keeps rising, as a lot of those factors that I mentioned, consumption growth, GDP growth, convergence happen over the next cycle, then GDP per capita rises, the yield that we may pay, or we will pay in the real estate market, may well be much lower, down towards the European levels. Now, obviously, political risk and other risks might play a role here, but that's where we can go in the next cycle. Let's see. How do we get there? Where's the liquidity come from? First of all, on the regional front, we have very high proportions of investment in the region in 2017. So quite a significant move into the regions in Poland, 89% of volumes in 2017. And it looks like 75% this year was outside of Warsaw. But the ratios in the other countries are lower. Somewhere like Hungary, it's very, very Budapest-centric. And particularly this year. And what's interesting, those dark blue bars on that chart are lower than the light blue bars. As in 2018, we are seeing less investment in the region, in the regions in the countries relative to the capital cities. So that's an interesting phenomenon. On top of that, then where else can we see liquidity? If you look at this pie chart, on the right-hand side, you've got here the UK and German volumes I took from RCA data for 2017. You can see 74%, 3/4 of volumes in the classic three sectors, office, retail, industrial, and 26% therefore in other sectors. So we're talking senior housing, student housing, apartments, residential, hotels, hospitality, other assets. So you can see that this is where the liquidity will come in the next cycle. And that will be where the money will come from in terms of generating fresh demand for assets. And finally, just to think about the peak of the cycle, we think that the cycle will peak top out sometime in 2019, but we don't think the downturn will be as severe as what we saw in 2008, certainly locally in the region. Domestic volumes and strong consumption trends should help us through this cycle. But the signs of the peak are there. I mentioned about the German economy, development boom going on, higher rents in the office sector, unemployment at record lows, wage growth going up, and therefore interest rates also going up. So all of those things are telling us that the peak is quite near. They're all signals of a cyclical top. Then what comes beyond it, we don't think we'll see a locally induced sharp downturn, as I just mentioned. But there may be risk aversion factors that affect it from the globe, from global risk. So emerging market risk, Italy risk, then what's going on between the US and China in terms of the trade situation, the overgearing that I mentioned in terms of global debt, that might cause a bigger downdraft. And then there's also taxation risks that we also have to think about. So all of those things may exacerbate any downturn, but we're not thinking that 2008 will be repeated in 2019, 2020, 2021.